Hi, I'm Kezia Samuel, and welcome to Mark to Markets Beyond the Numbers edition for the first quarter of 2026, where we go beyond the data to unpack the key stories shaping markets. So let's start with one of the biggest drivers of markets this quarter, and that was oil prices. Oil prices have jumped sharply and hovering around $100 following the recent supply disruption, reversing what had been a relatively stable trend. Higher oil prices act like a tax on consumers, increasing energy costs, thus reducing disposable income, and that can weigh on spending and growth. At the same time, elevated oil feeds directly into headline inflation. Now, if this move is temporary, the economic impact should be limited. But if prices stay elevated, it could mean slower growth alongside higher inflation, complicating the outlook for interest rates. But the impact of higher oil prices is not the same everywhere. Countries that rely more on imported energy, like parts of Europe, Germany as an example, and Asia, Japan as shown here, are seeing more pressure in their stock prices, while more energy-independent markets like the United States, while still negative, are holding up better since the war started. Now, bringing that closer to home, we can see the impact of higher oil prices are showing up in the U.S. markets as well. Energy has been a standout performer year to date, benefiting from higher oil prices, while economically sensitive areas like consumer discretionary and financials have lagged. At the same time, we're seeing weakness in the market's biggest AI-driven names. The Mag 7, which we've talked about in the past, have pulled back meaningfully even as the broader market has held up relatively better. The key takeaway is that markets are becoming more fragmented. Leadership is rotating away from last year's winners towards more traditional sectors like energy, reinforcing that importance of diversification. So with that shift in equities, what's happening on the fixed income side? Markets have shifted from expecting rate cuts to now anticipating the Fed to hold interest rates higher for longer. This has pushed up yields across maturities for the U.S. Treasuries. As yields have moved up, bond prices have seen modest declines. The flip side is that income is now more attractive, offering a better yield opportunity for investors going forward. And that rate environment is also impacting other asset classes like gold. Geopolitical tensions have lifted the US dollar as investors look for safety and are benefiting from higher interest rates. This marks a notable shift from earlier in the year when the narrative was more focused on selling U.S. assets. At the same time, investors have taken profits in gold, especially as other markets have sold off, which has also limited its gains. The key takeaway, again, is that while gold typically benefits from uncertainty, a stronger dollar has shifted the narrative and investors' positioning to keep its upside in check. So stepping back, we can see how all of this is coming together across markets. Since the war started, we're seeing weaker performance outside the US, strength in oil, and a shift away from that growth leadership. So what does all this mean for investors? The key themes are higher oil, higher interest rates, and changing market leadership. And in that environment, staying diversified and focused on long-term positioning remains critical. Thanks for joining us for Mark to Markets Beyond the Numbers edition. We look forward to continuing to help you make sense of what's driving the markets.